The Sustainable Capital recently penned a newsletter to clients which identified some of the myths of investing on the African continent. One of these myths is that the best way to access African companies is through private equity. Greg Barker from Sustainable Capital joins us from Cape Town to discuss these myths, along with prominent ESG architect Graham Sinclair. Greg, great to have you on the show. We obviously wanted to get into some of these myths. You've penned this newsletter, I guess, to principally your investors, talking about some of the myths of investing on the continent, and we've identified one of them. I wanted to start with the reason you had to address some of these myths. Are there questions still around the idea and viability of investing on the continent at this point?
Yeah, I think, Warren, myths tend to perpetuate themselves in environments of imperfect information. And Africa's financial markets certainly fall into that category. What we've seen since we started Sustainable Capital 5 years ago, focusing purely on listed equities in Africa outside of South Africa, is that there are several cases where the reality is totally out of touch with the perception of these markets. So we thought now was an appropriate time to set some of those myths straight and debunk some of them by putting forward the facts and the evidence.
Let's start with the myth that we identified in the introduction there. Obviously, what's the best way to access African companies? We've had John Oliphant from the GEP, the Government Employee Pension Fund, on the show, and he was talking about increasingly using private equity to access some of the opportunities on the continent. But you seem to be quite comfortable in the fact that there's plenty of listed entities to invest in. So just carry that forward for us.
Yeah, the normal myth is that, you can't invest in listed equities in Africa outside of South Africa because liquidity is too constrained. So go the private equity route. We would contend that investors should pay attention to both asset classes at different points in the valuation cycle. And it's certainly a no-brainer to buy listed equity at the same valuations at private equity when those opportunities arrive, given the liquidity premium in your return that you should enjoy for the lockup of a 5 to 10 year opportunity cost in a private equity fund, whereas listed equity, you don't have that liquidity constraint. And I think quite strong evidence of that includes private equity funds. And you mentioned the PIC. They recently bought a share in EcoBank, which is an Africa dominant commercial bank, at a premium to the listed equity price. So what that tells us on a look-through basis is even private equity managers are seeing value in the listed equity markets.
You identified some other myths, and I think I just wanted to get to some of those as well. Clearly, one of the myths around investing in Africa is that it's more risky. What do you say to investors who come with that bias?
I think it depends how you define risk, and you need to separate out what is socio-political risk and what is investment risk. We define investment risk as coming from two things. Firstly, not knowing what you're doing. In other words, not knowing enough about the company that you're investing in. And secondly, price component. And price is not a part of socio-political risk. So counterintuitively, it's often where you see the greatest short-term perception of socio-political risk, which is driven by bad news stories of Africa that actually give you the best investment opportunities. Also, in a portfolio context, if someone is taking Africa as a portion of their overall investment portfolio, it's one of the last uncorrelated listed equity markets in the world. If we do correlations over 5, 10, or 3 years, you're getting correlations of as low as 15% with developed markets or even with South Africa. So in that context, Africa outside of South Africa is actually quite low risk, in contrast to the common held perception that it's off the page risky to invest in these companies. If you're not overpaying and you're buying high quality companies in an uncorrelated asset, it's quite low risk in a way.
We've kind of got to the point where we talk about Africa as if it's like the EU. It's a very complex continent, lots of different cultures, languages. How do you go about sifting through a continent as diverse as Africa is, and I guess preventing or addressing the potential that it's homogenous. Africa's the same anywhere you go, whether it be West or East or South Africa or Southern Africa?
Yeah, the term Africa itself is almost irrelevant from an investment perspective, apart from the common characteristic that you get imperfect information and therefore very good opportunities to generate stock-specific alpha. But you've got 53 countries in Africa, and you've got, of those, less than 10 which really represent more than 95% of the listed equity market. So, we really focus down onto those countries where it's material. And then we do our research purely on a company-specific basis. So obviously taking into account country risk in your discount rate, we'd be looking at companies across different sectors in a multi-country environment on a purely one company against the other on pure investment basis. What's the fair value, what's the discount to fair value of those companies, and make a decision of where to allocate the capital, irrespective of which country or sector that company happens to be in.
Greg, just that process we wanted to talk about that makes your process different to a conventional asset manager, if we could call them that. Just identify, for the benefit of our viewers, where you differ and where your emphasis differs from some of the conventional money managers that you compete against.
We tend to spend more time focusing on long-term sustainability risks and opportunities. So, for example, material off-balance sheet, environmental liabilities, social factors like labor practices, or economic factors and corporate governance risks, which ultimately impact on shareholder value, but tend to be neglected by more short-term investors. So we would be integrating that into our portfolio construction process and our investment decision making, which may lead us to a different conclusion to a mainstream asset manager.
So I just wanted to bring Graham in here. Obviously, Graham, as an ESG architect, your focus and the case, I guess the thesis that you're making is that factors that Greg has just spoken about are important. How much overlap is there with the direction that you're promoting and encouraging and the position that Greg takes on this topic?
Well, I think Greg's shop, Sustainable Capital, and I don't recommend any investment fund or any particular company to invest in, but I'd say in the main, Greg's approach and the approach of Sustainable Capital is frontier approach, both in terms of the regions that they're looking to cover, actually getting people on the ground, asking awkward questions of management, visiting the sites, and then the way they're looking to factor in the environment, social and corporate governance factors. From our point of view, it's where all of investment management thinking is going. Our view at Cinco is very clearly that every investment decision has environmental, social and corporate governance factors in it, ESG factors. The only question is how good is the investment manager at identifying those, finding the opportunities and protecting against the risks.
In terms of, Graham, just staying with you, some of those risks that you've identified, I just wanted to see the overlap. Obviously, we've got Greg addressing some of these myths around investing in Africa. Are there any myths you'd like to address from the ESG side, especially with regard to African companies?
Well, I think one of the first ones I'd offer up is from research we did for the IFC, which indicated for investors general asset management as well as private equity asset management into sub-Saharan Africa, the number 2 most important factor for investors was corporate governance. So it's a complete myth to say in some way ESG factors are going to hold you back, reduce your universe, be some kind of drag on the quality of your investment management process. On the contrary, especially in those markets where you're perhaps less certain about information, you need a greater degree of comfort both in the underlying portfolio company or the investment managers. It's going to be important that you include the ESG factors like corporate governance, like social and environmental risks. If there's 262 funds looking at investing in Africa today, according to our research, there's around just over 1,500 in all of Africa. 262 are Africa funds. Look, 3 out of 4 are based here in South Africa. And we know South Africa has been a real leader on the continent, looking at corporate governance factors, looking at King 3, looking at the code for responsible investment in South Africa. So it's absolutely clear that ESG is a new theme, and more it's finding its way into the way money is managed, especially in Africa.
Just to go back to Greg quickly there. Greg, you've heard about Graham discuss some of the ESG factors in principle there and how important they are. In terms of your process though, how much time do you spend on the ESG? Are there certain minimums there that certain ground you need to cover to be comfortable that the company you're looking at is going to be worthy of an investment?
Yeah, absolutely. I mean, you certainly don't want to leave too many stones unturned, which is why we spend a lot of time on the ground. And our motto at Sustainable Capital is no stuffed chairs. You know, there's no chance of sitting in an air-conditioned office doing research on African equities, because you're likely to know just enough to be dangerous. So you've actually got to be kicking the tires, looking the CEO of the company in the whites of his eyes, asking difficult questions, and doing your homework accordingly, because without that, you know, you're likely to uncover nasty surprises as time goes along.